Let's talk about a couple of simple tips and tricks when it comes to multi-imbalance points. As you know, these are very important price action concepts that help define our main points of interest when we are trading. But sometimes price can completely crush these areas and wipe out to imbalances with no reaction at all from the market. This is why I always say that if you are using only a single time frame, you need to be extra careful and be more selective. In general, what we really want to see is a little bit of a struggle and a station in these areas before making any decisions. That could be things like rejection wicks showing up, or even a swing failure pattern forming as a clear concept. To me, this usually means that traders on the opposite side are reacting to this level and considering a possible reversal point. One of the best ways to look at the charts is by opening up the lower time frames in these areas and watching how the price behaves here. You want to see if price keeps making new higher highs, showing that buyers are getting control. Basically, you are looking for an inner upward trend developing so you can eventually join the stronger side of the market. For example, Ethereum had a really great setup recently. I know a lot of you probably took this trade as well. There was a strong price push through these levels, creating this clear multi-imbalance area. As you can see, price pulled back into this multi-imbalance zone, but at the same time, it formed a multi-swing failure pattern at the exact same level. So the price was clearly being rejected from that area. As a clean target below, we had the PDL, which is the previous day's low level. This made it a complete and a very clean example of a high quality trade setup. However, if you look above this area, you will notice multiple bullish imbalances sitting overhead. I think this also looked like a solid area someone might consider taking a long trade here. However, if you look more carefully at this zone, there is no swing failure pattern or any type of rejection wicks. There is also no inner structure break in that area at all. Instead, there's a strong and aggressive price push towards downwards. This tells us that buyers at this level were not able to push the price higher in any meaningful way. These are small tips and details that you really need to look for before entering any kind of trade. Now let's drop back down to the lower time frames and take a look at our short trade idea. So, if you remember with this multi-imbalance and multi-swing failure pattern area, what happens here? Let's break this down for a second. For example, price could have easily continued moving higher and kept its bullish inner structure intact. This is exactly why checking lower time frame structure is sometimes very important. But instead, what happened here is we got a clear inner structure break and price crashed down toward to the PDL, the previous day's low. This ended up being a clean and a solid 2-hour trade opportunity at least here. As you can see, following liquidity, imbalances, and structure changes all together is extremely important when it comes to the trading. Today, let's think about point of interest areas and why they actually matter in trading. In reality, everybody has a different kind of point of interest or POI area they focus on. They might use indicators, simple price action, or even smart money concepts to define those areas. So overall, you will always have some kind of idea about where your point of interest is on the chart. Now, the most important question is this. When the price comes into your point of interest area, what should we actually do next? For example, imagine this POI area is for a bearish setup and I'm looking to take a short trade here. If you look closely, once the price comes into my zone or pocket, I could technically take a blind short right here. This is definitely possible and sometimes I personally do that in certain situations. However, this is a low probability trade and it requires a reduced risk management. The reason is simple. You do not have any lower time frame confirmation in this moment. So a better approach is usually to use lower time frame structure and trend for confirmation. For example, inside the POE area, if I see price keep making new lower lows and then start to break down aggressively, that tells me that sellers are taking the control now. The selling pressure shows a real seller power. And now I can look for short trades with much higher confirmation. In this case, we can call it a confirmed short instead of a blind short. You can absolutely use both trade ideas in your trading plan if you want, but you cannot assume these are the same type of trades. One of them clearly has a lower probability, and the other one has a much higher probability of success. If you were watching the Ethereum chart recently, you probably noticed a pretty clear and important pattern forming on the early charts. What was happening was one of my favorite patterns to trade, where the price was overall stuck in a strong crushing downtrend. During this downtrend, price kept pushing back into these imbalance areas and also tapping into previous support and resistance Philip levels. In both of these situations, you can clearly see how they create really solid short selling opportunities. So, when I saw this last setup with that imbalance and the support and resistance Philip point, I immediately started thinking about another crash coming. And if you carefully look at the chart, you can see that clean crash actually did not happen at all. Instead, with that last pattern, even though I fully expected a crash, the setup failed really badly. It completely broke down and basically destroyed my trade idea. This is exactly why it's so important to check the lower time structure and the overall trend before taking a trade. Now let's drop down to the 5-minute chart and talk about this little more. When I was looking at this last setup, I also noticed the previous day's low level sitting right below the price. That detail alone actually gave me even more confidence to consider taking a short at this trade. This was because it was a very logical and expected price movement based on where we were on the chart. But if you carefully look at the inner structure, there was this very clear and undeniable uptrend moving upward, and upward, consistently pushing the price higher. So the lower time frame was not aligning with my higher time frame idea at that moment, which was a red flag for me. In my point of interest area, I should have seen something very different happening. I should have seen a bearish trend or a bearish structure clearly forming and moving toward the previous day's low area. For example, I would have wanted to see a clear and strong microstructure break followed by a couple of break of structure moves starting directly from my point of interest area, the POE area. This could have been a great trade in my opinion, but unfortunately that confirmation never happened. So, like I always say, combining liquidity, imbalances, and structure together all at the same time will give you the best and highest probability setups in your trading journey. So with the new year starting, I'm expecting a much better price action after that really horrible December we just went through. What I want to do is here to teach you why you should not get stuck on a single bias and why you need to adapt market conditions in a dynamic way. Generally, when a market crashes badly or stays in a strong downtrend, we need to follow the flow because that is usually the best overall approach. And using multi-imbalance areas with SR Phillips is a great idea because price love to flow towards open liquidity areas. So, as an experienced trader, this should be your logical and expected move, which is downwards. So as an experienced trader, this should be your logical and expected move, which is downwards toward the open liquidity points. However, this is exactly why I always talk about combining imbalances, liquidity, and this structure together, because that is the best idea for trading. If the inner upper trend is not broken and keeps going upwards, it means price is still looking for another set of liquidity above. So you cannot just blindly short every short setup if you do not get enough confirmations in these markets. And the easiest confirmation to watch would be the lower time frame structure. Keep a really good eye on the lower time frame structure before taking any kind of trades. In Bitcoin, we had a really good example of this recently. There was a significant multi-imbalance area with a clear SR flip location. Logically, I was thinking, can we move lower from here and push towards this significant liquidity point? But that actually never happened because the lower structure, as you can see here, was never broken at all. If I had seen strong breaks downwards followed by a couple of structure breaks, this could have been a great short opportunity. But instead, if you carefully look above, you will notice the relative equal highs sitting up there. That was a strong reason for the price keep moving higher to take out that liquidity. And the inner structure was never broken and just keep pushing upwards. Because of that, we need to shift our thinking and realize we are going higher, not downwards. This is how you dynamically change your bias in the markets. You need to combine nearby liquidity levels with how the inner structure is moving towards those liquidity points. As you can see, you cannot trade what you think. You need to trade what you actually see on the charts. In this episode, we are going to dive into a student's trade and really break down what he did and how he took the trade from start to finish. Along the way, I'll also talk about our indicator with multiple time frames and explain how to actually use it in a simple, practical way. As you already know, multi-imbalanced areas are great places to look for trades, especially when you're trying to plan ahead. More importantly, what happens inside these areas is extremely important and can tell us a lot about price behavior. One of the first of strong tradable areas is seeing swing failure patterns, especially when they are combined with support and resistance flip points. This gives me confidence that a possible reversal can happen in this area instead of price just continuing in the same direction. So what we expect to see here is a structure shift followed by a price moving toward a clear target, possibly. Targets like major liquidity points such as equal lows, equal highs, or the previous day's low or highs can be great open liquidity targets for us. So what we really need is strong and meaningful liquidity areas that are capable of pulling the price towards them. And in the end, what we want to see is a structure shift and a clean trade opportunity like one shown here. As you can see, this is a complete price action setup that can be used in almost any kind of market situations. Now let's get back to the student trade. First of all, by using this ICT high time frame candles indicator, we can identify and analyze multiple time frames at the same time. This allows us to see different types of price action and smart money concepts together without constantly switching between time frames. For example, when you look at the 1 and 2 hour time frames, you can clearly see the multi-imbalance area, followed by a multiple swing failure patterns and multiple SR flips at once. Because of that, you immediately get a clear trade idea along with an expected move that could happen. The next thing you should ask yourself is whether there is a real reason for the price to crash downwards, a possible target maybe. Now, when I open the 5-minute time frame, things actually become much clearer. This is where the multiple smart money concepts and price action methods really come together. This is the exact area that we identify using our indicator. When you look below, you will notice some very interesting targets. First, we have the PDL, which is the previous day's low area. On top of that, it is actually combined with equal lows that formed later on. So now we have a logical and clear reason for the price to crash down into this area. After that, the rest is simply a structure shift and taking an entry. This is really a strong setup. Probably one of the A++ setup that you can come across. I want to congratulate all the students who were able to take this trade. Great work, guys. Let's talk a bit about important price levels and how to handle trades when the price comes into these levels. For example, the first important question is, after this level is taken out, what exactly should we be looking for in that moment? How can we react properly as traders? What is really happening with price action around this level? Will this price level be broken with a strong momentum and then turn into a support and resistance flip area, like in these examples? Or will these levels act as a critical points that signal a possible reversal instead? So what clues and tips can we use to better understand what the price is telling us? First of all, if these levels are broken very strongly, there is a much higher chance they can turn into support and resistance flip points. For example, during a retest, you might notice a rejection wicks forming right at those support and resistance flip levels. This usually happens in continuation patterns where the price wants to keep moving in the same direction. However, if these price levels are broken and price immediately come back with large wicks or swing failure patterns, that has a different story. Once the price moves back inside the range again and keeps rejecting the same levels, there's a much higher chance of a reversal now. As you can see, this is not an extremely complicated way of looking at and reading important key price levels. Bitcoin had a really clean example recently. Once the price took out the previous day's low level, it briefly swept that area with a nice wick and then strongly moved back into the range. You can call this a swing failure pattern or simply a rejection wick, I don't care. The main idea here is that sellers were not able to push the price lower anymore, and buyers stepped in and reacted quickly. And in the next step, the internal structure was broken to the upside by the buyers. This clearly showed that sellers were very weak in the situation and buyers started to take control back. This was a solid trade example, and I noticed a couple of students on Twitter actually took this trade. I liked it. I honestly think it was a really nice opportunity overall. After that, price moved straight back up toward to the PDH, which is the previous day's high level. This was a classic move from PDL to PDH, or similar how the price often moves between PDH and PDL levels. So with this guidance, you can get a much clearer understanding of how the price may move around critical liquidity points. This also applies to any kind of structures like supply and demand areas, like order blocks where reaction often happen. Let's talk about the recent price action and how we can break down the technicals in this chart. The first thing you probably noticed is that the price was clearly pushing in one direction. That move lined up with the previous day's high and also connected with this 4 hours high. And if you look to the left, you will see that we got a set of equal highs sitting here together. So it was pretty clear that the price was working its way upwards. And imagine that based on the technicals you just spotted, you decided to take a trade. You took something like this simple, a compact, small 1.5 hour setup, basically a set and forget kind of trade. Now this trade could have lost or maybe not played out at all. What matters is that you outlined your plan and followed it. Now let's zoom in on the price action and really think about what actually happened here. One of the biggest questions is, what does the current structure look like before the trade? If you look closely at the price action, it keeps forming new higher highs and it moves upward. And basically, the buyers are stepping in, taking control of this move, pushing the price higher. This part is pretty clear. And next, we already noticed the most likely direction where the buyers are trying to push the price. This lines up with the previous day's high, the 4-hour high, and those equal highs all forming together. And finally, we've got this interesting imbalance sitting here. If you take a careful look, you can see that it is completely filled. And if that imbalance holds, this could be a solid place for me to put my stop loss for the moment. It is actually a very simple idea. If the bullish structures keeps holding, we are most likely keep going up. However, if the bullish structures start to fail and one after another, it is probably sellers taking the control. It is a super simple concept that you can use in your trading and thinking. In the end, this is not an amazing trade as you noticed, because you don't really have much room for a nice reward when your stop loss is pretty big. But in trading, this is where things get tricky. You can't expect big rewards all the time. Honestly, most of the time you won't get them. And that's why I always say to keep your rewards tight, realistic, and compact as much as possible. Because at the end of the day, it is much better to lock some profits than wait forever and end up losing the whole thing. This month was very tough for day traders overall. Most of the time, there were simply no great setups available to trade. However, even on some days when we did notice great setups, really A++ setups. This was all thanks to our indicator called ICT high time frame candles, which helped us spot interesting points of POI areas and to trade them. By using this indicator, we were able to clearly identify this multi-imbalance point right here on the chart. As a form of support, you can also notice multiple swing failure patterns forming together on the order charts as well. And finally, we can see a very clear target below, which is known as the previous day's low, the PDL. So, what we did here was actually very simple and straightforward. We waited for the price to come back into our multi-imbalance area. Then we looked for supportive structures such as support and resistance flips or swing failure patterns like the one shown in our example. We combined this with clear targets such as the previous day highs or the previous day lows to define our directional bias. This is your high time frame analysis explained in the simplest way possible. After that, the rest is just checking the same point of interest area on the lower time frames like the 15-minute or 5-minute charts, or even lower if you want. What we do here is not a rocket science at all. What we do is, inside our point of interest area, the POI area, we wait to see if the structure turns to bearish and starts falling to take out the previous day low or something similar. I really hope this is very clear and easy to understand for you. When you open the lower time frames like the 15-minute or the 5-minute charts, the first thing you will usually notice is the area of multi-imbalance and those multi-swing failure points showing up clearly. And if you look below the price, we already know we have the PDL, which is the previous day low sitting right here. And below that, we also have this very clean, almost perfect equal loss, if you've been paying attention. That alone gives us another strong and logical reason for the price come down into this area. When we look at the price action first, you can clearly notice this inner uptrend price movement forming step by step. This structure is very obvious and is the spot on the chart. And then at some point, that uptrend is clearly broken and no longer holds. That is when sellers start to step in and actively push the price lower. This moment is what gives you the trade opportunity if you are looking for usually with a clean 1.5R or even 2R setup with tight and compact setup. I can easily say this is an A++ pattern because all the key structures lined up together perfectly in this example. For example, we have multiple imbalance areas stacking up in the same zone. We also have very clear multiple swing failure patterns forming at the highs. On top of that, we have a very clear and obvious target sitting below the price. Then if you drop down to the lower time frames, the inner structure flips into a bearish structure. This aligns perfectly with our directional bias to the downside, targeting the PDL and the equal lows below. Even though I absolutely love this setup and trust it a lot, the main issue is this setup does not happen every single day, unfortunately. In fact, over this recent month, we have only seen a few truly great setups like this one overall. Let's take a look at this 5-minute Bitcoin chart and do a bit simple brainstorming together. At first glance, you can clearly see this very obvious support and resistance flip area on the chart. If you look lower on the chart, the market was crashing hard, but then turned around after this market structure break, which triggered a very strong bullish reaction. So naturally, you can see the market kept making new higher highs and repeated break of structures to the upside. Eventually, taking this long trade feels very natural and logical in this situation. That's because the market kept making new break-off structures higher and showing clear bullish strength. There's also a clean support and resistance flip here if you noticed. And you can clearly see the imbalance area right at the trade entry zone. But this trade ended up failing in the end. However, a failed trade does not mean the idea itself was wrong at all. This is actually a very solid and great trading idea. And if I solve this setup again, I will take it over and over and over again without hesitation. It really doesn't bother me at all when a setup like this loses once. Later on, you can see that the overall structure started to shift downwards and the bears slowly took the control again. Price kept making new lower lows and continued pushing the market lower with a strong momentum. If you took a logical short position here, that would not be wrong either. The reason is simple, because price was clearly crashing and following a strong bearish momentum. This is exactly how you follow the momentum in the market. It is almost always better to trade with the power and the momentum rather than trying to fight the markets and reverse the move. And sometime later, if you pay close attention, you will notice the structure changed again with the strong move from the bottom all the way to the top. If you look above again, price came back into this support and resistance flip area along with an inner structure change. This time, the trade actually worked perfectly as we planned. So when you compare the first trade and the last trade, you see one loss and one win. But if you really study them closely, you will notice they are basically 100% identical trades and patterns. So what you do as a trader is keep playing the same patterns or strategies again and again without changing your approach. So what is the real meaning of this video and why does it actually matter? It is honestly not overly complicated at all when you break it down step by step. As you can see, we played the exact same patterns in both examples without changing anything. We had a SR flip, followed the bullish momentum in both trades, and waited patiently for an inner structure shift to enter clean and compact trades. Even though we played the exact same patterns, the first trade failed, and the last trade ended up winning. And this is where the real trick of trading of the same pattern actually comes from. It all comes down to timing and the total number of trades you take over time. Because if you keep trading the same patterns, it honestly does not matter what the tool is. It could be RSI trading, it could be trend-based setups, or it could be even moving averages. If you take the same trades over and over and over again hundreds of times, what we are really trying to achieve here is the net profit at the end. A lot of people focus too much on a single trade instead of a bigger picture. For example, they say, I used this pattern once and the trade failed, so this pattern must be useless. But the truth is, you cannot see the results until you trade the same patterns, setups, or strategies consistently for hundreds of trades. With the start of 2026, we are finally starting to see much clearer price action after that really rough December. By using our simple ICT high time frame indicator, we can once again spot some very solid trade zones to look for great entries. Especially this multi-imbalanced area in the middle, I've noticed that many followers on Twitter picked up on the same idea. On top of that, we also have these very clear SR flip points that helps us pinpoint specific entry locations. And if you look at the overall price action, we are clearly in an uptrend right now. Price started around from 87K and has been rallying up towards the 93K area. So now let's drop down to the lower time frames and talk about what we can actually do with a chart like this. From the higher time frames and by using our indicator, we already know this is a multi-imbalance area with an SR flip location that offers a strong trade opportunities. And right before our entry model, you can see these very clear equal lows, which can act as a perfect inducement point, which is also called IDM. So overall, this trade area is a strong field location and one of the best possible zones to look for a clean and clear setups. So what we are going to do next is zoom into this area and talk about how it can actually be traded. First of all, you can clearly see the market structure break right after the price pushed strongly into our solid entry location. So probably the simplest and the most straightforward way of trading is jumping into a trade right after the market structure breaks and setting a stop loss that is large enough to handle possible deeper pullbacks later on. Your second option is waiting patiently for the pullback so you can aim for a better entry and a higher target with bigger potential rewards. And if you look at the multiple other time frames, you can clearly see that there are some great imbalance points that can help you time your entry much better. And finally, your last entry model could be waiting for a couple more confirmations before entering the trade. For example, you might wait for the first break of structures and then wait another structure break right after that. So double structure breaks usually mean that the price is now trending. We have a much stronger confirmation to work with. These were your three basic and the most common entry models that you can use in trading. But I always get the same question from traders over and over again. I cannot sit and wait in front of the charts all day for my entries. And I get it because this is a tricky and very time-consuming process. If you do not wait for proper setups or a clear structure changes, you are basically limited to one kind of trades, which is the cost averaging methods, and nothing else. For example, there are three very good areas on the chart where you could place your limit yo-yo orders. The first one is the level of inducement, which is the equal low area, because price will probably crash down and sweep this zone before making a strong move. Then you can place another limit order inside your SR Philip zone as well. And your final order could be placed at the fulfillment of the inner imbalance area for extra precision. So when you trade any type of cost averaging or scaling based strategies, you also need to have a clear mental stop loss in the place. For example, imagine all your limit orders get filled, but the price does not react at all and just keeps crashing through the area. In that situation, you cannot keep cost averaging forever, especially in trading. And there must be a clear point where you stop yourself. There should always be some limits in place where you mentally decide to cut your losses. For example, if all the structures in this example, bullish structures, are broken and price is not moving in your direction at all, that is your biggest and clearest clue that it is time to cut the trade and walk away. Today, let's talk about how we can save ourselves from getting stuck with bad trades in the market. Because saving money is just as important as making money, especially when you are trading. When you look at this chart, you can clearly notice that on the multi-time frame indicator, there is these three very distinctive bullish imbalances right in the middle. There is also this SR Philip location that I expected would cause a bounce in the price. So this ended up being my logical trade idea after carefully analyzing and reviewing these high time frame charts. The first clue you want to look for is whether we are forming any kind of swing failure patterns in this area, or if the price is simply crashing straight down. As you can see here, there really isn't much strength showing up at all. The sellers are very strong in this area and keep pushing and crushing the price lower and lower. Because of that, this multi-imbalance level is clearly not holding up the way we would want it to. The next thing you always need to check after that is what is happening on the lower time frames. On the lower time frames, the most important thing to focus on is the structure and the overall trend. If the lower time frame trend keeps breaking downwards and making new lower lows, this is a clear sign of weakness in the price. To take the healthy and higher quality trade, I need to see some real buyer strength step in here. For example, I want to see take out recent highs and continue making higher highs in the area, which would show a developing uptrend and buyer power. Now let's check the same area on the real-time charts using the 5-minute time frame. First of all, let's talk about what we actually have here in front of us. We have this nice inner SR Philip location, as you can clearly on the chart, and top of that we also have these open liquidity areas sitting above us for our clear targets. So naturally, my normal expectation here would be price moving up from this area, because we have strong signs and very tradable zone shoved up here. But now let's slow down and talk about the inner trend on this chart, specifically the 5-minute trend. If you look over the left side, you can see we were in a clean uptrend, pushing higher and making higher highs, and taking out the previous highs step by step. Then that inner trend structure completely shifted and changed into a clear downtrend. You can also look at the smaller inner trends if you want to, which keeps making lower lows and getting crushed over. So, when I look at this 5-minute chart, everything I see is telling me that the uptrend, low time frame uptrend is broken here. Right now the sellers keep pushing and selling without any change in the inner trend structure. And this inner trend is clearly pointing a downtrend movement. If I want to take an A++ solid setup here, I need to see some upside movements first. For example, taking out these previous specific high areas. And if I need to see further confirmation, I need to see making continuous higher highs before taking the trades. This is one of the most important ways to stop losing money and wasting cash in the trading markets. We will continue working on our simple multi-time frame indicator to find great trade spots and learn how to use these interesting trade areas. According to our multi-time frame, I see the high time frame indicator. This in the middle location is a great location with multiple imbalances points. This area gave us an opportunity to look for trade entries on the lower time frames. Now let's check out the 1 hour time frame in detail and talk further about this trading area. In this multi-time frame, multi-hour imbalance area, you also have a nice SR Philip point. But this is not an ordinary point. It was also the previous week's high and acted as a masterclass amplifier. And if you look below, the overall trend had already changed the upside before. Because of that, I can side with bulls and the buyers. Notice how the structure changed days ago. Price kept making higher highs. When you see price taking out previous highs one after another, it shows strong buying power. This acts as a form of confirmation for an uptrend. Now let's check out this area on the lower time frames and talk further. Now we drop down to the 5-minute time frame in our trading area. What you see here is the first clue that you can get. Look at how nicely the internal liquidity is building up. Sometimes people ask me, what is an inducement, the IDM? An inducement is this liquidity building up in the areas right before your trade entries. What happens here is price makes a small crash to sweep all this liquidity and fill up before a big movement. If you look to the left, it hits this internal SR Philip point. This area is also a structured box with a protected low. So what you are seeing here is actually a masterclass level A++ setups. So many masterclass level I teach comes up here. And this does not happen every single day, but this is an extremely clean price action. Now after this, things get a little bit more interesting. Before entering any kind of trade, it is always good to see a structure shift in your favor and in your trading bias. What happens here is the first market structure shift shows up right here. This gives you the first trade idea along with the internal imbalance. But like I always say, sometimes the first structure shift can be tricky. You might miss it if you are doing something else as well. That's why it's always smart to wait for the first break of structure right after the market structure break. This acts like a double confirmation here. Then your secondary trade could look like this one right here. Unfortunately, there is not much to do about waiting long times. If you want to be a trader, you need to accept that you need to spend a solid 3, 4, 5 hours in front of the computer to make any kind of money. There's no other option here. Let's talk about multi-imbalance areas and how to look for possible trades inside these areas. What we do here is actually not that overly complicated, but the problem is that things do not always happen the way I want them to happen. For example, ideally, seeing an SR Philip area along with the special structure movements inside these imbalance areas would be great to see. So, for the example, price making higher highs during an internal pullback, which I like to call an inner upper trend, is what we want to see first as a pullback. Then what I would like to see the next is clear shift in the structure. So the uptrend turns back into a downtrend again. following the general price action. And after that, price crashes toward an ideal targets like the previous day's low or the week's low. So what you see here is the ideal and the most optimal price action that we want to see. But unfortunately, this does not happen every single day. For example, Bitcoin had this pretty incredible crash recently, dropping from 95k down to the 91k roughly in 2 hours. Now, honestly, I do not enjoy crashes like that because this is not really a clean price action in my view. This kind of move is basically news-based, a global reaction crash, instead of something driven by natural price action. However, if I really wanted to trade this move, I would much rather to see price slowly pull back in an upper uptrend into this support and resistance flip area, for example. That type of move would be my ideal setup and what I would expect from healthier and more controlled, nice, clean price action. The reason is because the news-based gigantic multi-imbalance areas are extremely hard to manage. We also do not really know what might actually happen inside this zone once price is moving through them. However, if you still focus on the price action and structure itself, especially for example in this case 1 hour chart, you can see the move shifting downward to take out the PDL below. So what you are seeing here is a clearer price movement with an inner structure trend change moving toward a clear target. However, I have to be honest here. These multi-big imbalance areas caused by news are not healthy at all and are not great price action to trade with. If you go down to the lower time frames like the 15-minute or 5-minute charts, you can see the inner structure much more clearly. After a big news drop, price usually starts to pull back with an uptrend first, creating small, higher highs along the way. That inner uptrend then breaks and turns back into a downtrend again to hunt the PDL, which is the previous day's low below in this example. So in this case, the trade does work out. But the real problem with this news-related price action is the uncertainty. We honestly do not know how far the price can pull back or how many times that inner trend might change direction. No matter what approach you take, you still need to combine liquidity, imbalances, and the structure together. Those three elements working together are always what give you the best possible results in trading. Today, let's do something a little different and talk about how trading looked during the month of December. What you see here is the range that was creating during December, showing you about 30 days of price data. As you can notice, Bitcoin has been stuck inside this range throughout the last month of 2025. But if you zoom in and look at just the last 2 weeks of the year, the price looks even more stuck inside this small range, tidying up more and more. And trading these very small ranges, especially without any strong or meaningful price action, is usually very difficult. But if you step back and look at the rest of the year, the picture starts to look a little different. So what actually happened in 2025? First, price crashed hard from around $100,000 down to the $75,000. Then we saw a strong rally from 75k up to the 125k, where the Bitcoin broke records and printed new all-time highs. And after breaking that record, the price started crashing really badly. Now we are simply stuck again, trading sideways inside this range during the month of December. So my question is very simple. Why do most strategies, methods, or patterns generally break down in the month of December, and why does this apply to almost all kinds of assets? There are 5 very common reasons why this usually happens. Let's go through each one step by step and talk about what to do during the month of December. The first and the most common reason is the holiday break. In December, big players like banks, funds, and other institutions, along with many traders, start taking short breaks for the holidays. Most of them simply want to rest and stay away from the markets in the month of December. This behavior reduces overall trading activity across all type of order books. This is actually what I do in December as well. Most of the time I take small breaks from trading or investing and stay on the sidelines. Since many people are on holiday or just resting, trading volume drops significantly. This is why we often see long duration of price moving sideways in very tight ranges. For example, Bitcoin has been stuck around 90K for the past month. Another factor is something called tax harvesting. This simply means many people sell their losing assets in December to lower the taxes they owe. This creates price movement that don't really make logical sense at all, often break clean price action. For example, you might see a great long setup, but instead of buying, you may sell open positions just to reduce your taxes. This creates price action that feels completely illogical. This is why the pattern's breaking. Banks and funds also clean up their books and prepare for the new year during the December. Because of that, they usually stop placing large orders in the markets and rest like everyone else. So, when all these reasons come together, they break normal price action logic and the patterns. As a result, common patterns, strategies, and methods tend to stop working in December a lot. This is why price action becomes really choppy in the month of December. It moves up and down again, all within very small range, just like what we see with Bitcoin. So, what should you do in December? What is the best course of action during this time? It is actually quite simple. Just relax and slow things down a bit. Reduce your trading and investing activity in December and give yourself some rest. There's no need to lose unnecessary money in these choppy markets with very low volume and illogical price actions. Just wait for the new year and start fresh when the conditions improve. So, wishing you and your loved ones healthy, happy, and green New Year. Completed the free trading course but still need more? My master classes teach liquidity, imbalance, and the market structure in detail. Combine them with forward and reverse trading using momentum superboxes and yo-yo cost average entry models. After that, you will master scalping with a one-screen free trading view indicator, a revolutionary trading system. Finally, you will learn to invest your profits using my 10-year swing investing with working agent system. Interested? Please see the video description.